Welcome to our key points for November. This month we are looking at the global economy, on how the seemingly never-ending Brexit saga is developing, and finally what this all means for financial markets. Now, global manufacturing recession is still intact and many of the business surveys are still negative. However, on the positive note, we see some stabilization finally. In China, GDP growth fell to a record low, but it is still up 6% year on year according to the official numbers. And here as well, when we look at the economic indicators for September, they are actually doing better and came in better than expected. Now, our biggest worry is that the problems in the manufacturing sector are spilling over to the so far resilient services sector and the labor markets. And here indeed we already see some proof that that is happening. Global central banks keep cutting policy rates. Recently we have seen Russia, Turkey, Chile, Indonesia, but also in the Philippines and in Singapore we have seen some sort of expansionary monetary policy, while for fiscal policy there are more and more requests for Germany to expand its fiscal stimulus. Turning to the second point, we are finally coming closer to a Brexit solution. The EU has granted a deal with the UK to find a flextension, that's the word they are using, towards the end of January. There is now a solution that enables that there is no hard border between Northern Ireland and the Republic of Ireland, and that is enough for the EU to grant this extension. The British Parliament also agrees to a deal, however, it is not willing to rush through it and is not dealing with this tight schedule. However, Prime Minister Boris Johnson was able to find a deal with the opposite Labour Party to hold new elections in the second week of December. Now, the British pound has taken this all in a positive note and has rallied, making up some of the losses that occurred over the summer. However, UK companies are not benefiting from a stronger pound as most of their revenues are made abroad, and this is reflected in the underperformance of UK equities. European bond markets also reacted positively, with many of the 10-year bond yields bouncing from record lows. Now, turning to global financial markets, as we mentioned last time, very much depended on whether there will be a deal between the US and China concerning the trade war. And there was a so-called phase one solution, which we, however, believe is only a kind of temporary truce and definitely not a final solution to tackle the problems between the US and China in the longer term. However, there was a sign of relief in the equity markets. Investors took it as a positive, and that propelled the US benchmark index S&P 500 to record highs, while Eurozone and Japanese equities were also doing well. Meanwhile, the US earnings season is in full swing, and the so-called beat rate is roughly coming in line with expectations. Earnings revisions are still trending downward, but at least on a positive note, the momentum is now turning upwards. Investors that had been very bearish recently have turned to a more neutral stance, which is a positive. We think that the stance towards equities should be still rather constructive, and we think that is particularly true for equities versus credit. And we would only become cautious if there was too much euphoria kicking into the market if that were to occur. Remember that you can read our full report on zurich.com/MSME.